let's go back to a trade tab here for a second. An alternative, instead of paying 21.47 for 500 shares, you could go in and purchase options on Yahoo stock. If you purchase options on Yahoo stock, they do expire at a certain date in the future. So you'd have to select the date in which you'd like to buy your options. You have the July, you have August, you have October, you have January of 09, and you have January of 10. Those are the ones that are available right now. The problem is your timing. You can't really determine when, if, in fact, Yahoo stock is going to be bought out. So let's say you're relatively optimistic and you go for the August options. Well, the August options right now at the $20 level are selling for $2.87. The $22.50 level, the calls are selling for $1.65, and at the $25 level, it's 89 cents. So you figure, hey, look, if it goes to 30, I buy the 25s for 89 cents. A couple of these, if I was going to buy 500 shares of stock, well, I can buy 5 of these calls and basically limit my risk, and also have some good upside potential. Because if it goes up to 30, well, these 25 calls in August are going to be worth $5. So because they're $5 in the money. Now the only problem is, of course, you have to be right as far as your timing. August has to be, the deal has to come in August before the third week of August, in order for these $25 strike calls to be worth anything at all. If this goes to $26, well, you're just about breaking even. If the buyout price is $26, you're going to make those 25 August calls are going to be worth $1. So that's going to be, just about your break-even point right there after commissions, right? If you buy the 27.50 call, those are only 48 cents. But the problem is, if the takeout price is $30, you've only got $2.50. That's still not bad, because you're really basically, you're going 5 times the price or 4 times the price of what you're buying here, or maybe even 5 times the price. So, that's a good size profit. But let's take a look at the 25s, because you want to get that full $5 of, profit potential in there. But let's take a look at it and analyze it just like we did with the stock, and you can tell that you do have unlimited upside potential here. If the stock moves up to 30, you can make $2,400 on five contracts of the August 25 calls, but you also could lose your entire investment if the stock doesn't move. In fact, if the stock doesn't move within like 2 or 3 points here, you're going to lose your entire investment, which is okay. I agree, it's not much. It's only $445, but still, you don't want to do this 2 or 3 times a month. You don't want to do an investment, just buy outright calls, especially out of the money calls on these kind of stocks, and if nothing happens, you end up losing about $500. So in order for this to break even, you can see the break even price here is just a little bit above $25. In order for this to work out, you've got to be above $25 to make any money, and about $25. So anything below or anything above that, up to $25.25, you're going to lose almost the entire investment of $445. It's not a bad play, but I think we can do better. Let's go back and take a look at our trade tab for a second. Now, the other thing that you could possibly do is create a vertical spread. In other words, you want to buy a lower price strike price call, and you want to sell a higher strike call. And this creates a spread which limits your risk to the downside, because if you are wrong, the call that you sold will reduce in price, generating a small profit, helping you to reduce the risk on the long call that you purchased. So let's say you're really bullish, you really think this deal is going to work out. So you go for the 22.50 call and you sell the 30. You sell the one that you think is going to reach where the price is going to be if somebody does make a takeout offer. So if, let's say they offer $30 a share for Yahoo, that's the one you want to sell. if that's what your analysis is telling you. If you think it's going to be 35, well, you could go up to 35, but the problem is that these are so low priced that selling these calls up here doesn't really give you much protection on the downside, does it? So I don't recommend that. But this is a potential strategy. You go to buy a vertical spread, and the spread we want to sell is the 2250-30. We want to sell those 30 strike price calls there, and that's going to cost us $1.43 at the mid price. We'll probably get filled at around $1.45 for that, but it has the potential of moving up $7.50 if we do hit our price target. Now we want to do this 5 times, and we're going to go ahead and analyze this as a duplicate trade. Let's see what happens. Well, right now with the price just about right in here at 2151, which is right here on my graph here, what you can see is that, you know what, if it's you still have to move up in price in order for this thing to work. Yeah, which is expected, you know, and you really do think that it's going to hit 30. So now if you hit 30, you know, your potential payoff is around $3,000. That's a pretty good payoff, no doubt about it. I mean, if it works out and somebody does offer $30 a share for Yahoo, you're going to make about $3,000 because you'll be right in here. The problem is, of course, is if nothing works out at all, or just, you know, the stock goes up a little bit, you're going to lose potentially the maximum amount of money. In this case, it's $725. So if the deal does not work out, the stock trades down to $15, or even if it just stays the same, if it goes from like anywhere from, looks like $22 or $23 here. Let me just spread this out a little bit. Looks like around $23.66. If it doesn't trade that high, if it stays below that, you will have lost almost the entire investment of $725. Now that's even worse than buying out the outright call. The outright call only costs you $445. So vertical spreads can be good in these situations. However, you're still risking a maximum loss of $725, which is the cost of your spread. So is there an alternative? I mean, we looked at buying the stock, we looked at vertical bull call spreads, and now we've looked at, and we've also looked at just outright buying a call to take advantage of any upside potential. The problem, of course, is that you have a large downside risk. If the deal doesn't work out, let's go back to our chart here for a second. If the deal does not work out and it trades down to 1850 or below, well, you're going to lose all of your investment. Either in you're going to lose a lot of investment in your stock. You're going to lose most of the investment in your call. If you're lucky, you get out before the bad news hits, and you save a little bit of your call premium. Or you put on a vertical spread, a bull call vertical spread, like I mentioned, and you know that's going to cost you $725, and there's no guarantee that it's going to move up enough in order for you to get into any kind of a profit situation at all. None of these scenarios are really interesting for me. What I like to do is kind of introduce you to the concept, and I'm going to show you a portfolio of trades. Now, this trade in particular was shown to me by a 30-year veteran in the markets. In particular, one gentleman who had run a brokerage firm in New York City for many years had retired, and this is a strategy that he developed. And actually, he was going to retire, but he ended up not retiring, and instead, he started a small hedge fund that does only these kinds of trades. So this is really inside information that you're not going to find anywhere else. It's very similar to another kind of trade that's talked about a little bit in several different books, but it has a couple of different twists to it that I think you're going to really find interesting. If you know options at all, you know what a back ratio spread is. Well, this is very similar to a back ratio spread, only it's much more favorable to the person putting on with very limited downside risk, maybe even a profit on the downside, and unlimited upside risk, which you don't really get with a back ratio spread very often. So